Welcome to The Explainer. Today we're zeroing in on Warren Buffett's absolute secret to exponential growth. Now, when most people think of Buffett, they tend to picture this stock-picking genius with a crystal ball, right? But the truth is actually much more grounded and, frankly, a lot more accessible. His approach isn't some magical formula reserved for Wall Street insiders. It's just a highly disciplined system. And, as we'll see today, understanding this system fundamentally changes how you view time, money, and even your own psychology. Okay, let's dive into this because this stat is just wild. 90%. Over 90% of Warren Buffett's immense wealth was actually accumulated after his 50th birthday. Seriously, let that sink in for a second. He didn't make the vast majority of his billions in his 20s or 30s. This mind-blowing statistic reveals that his secret isn't really just about what he bought, but how long he held on to it. It's the ultimate proof that extraordinary wealth is usually the result of a long, quiet marathon, not some frenetic sprint.
This actually lines up perfectly with a famous rule from Buffett's late business partner, Charlie Munger. He famously said, "The first rule of compounding is to never interrupt it unnecessarily." And that right there is the foundation of their shared secret. It's not rapid trading. It's not constantly reacting to the 24-hour news cycle. It is the uninterrupted mathematical power of time. Because every time you jump in and out of the market, you break that chain of compounding.
Look, we all know the basic drill with simple versus compound interest. Simple interest is just a linear, predictable trudge, but compounding, that's where your gains start birthing their own gains, continuously updating your growth base for these massive exponential returns. It doesn't just pay you on your original investment, it pays you on all the interest you've already earned along the way. It feeds on itself.
You've probably seen this formula a million times since high school math, but look closely at the architecture of it. The real secret here isn't the principal, and it's not even the interest rate. It's that little t at the end. Time. Time is the only exponent in the whole equation. It's the silent heavy lifter that makes a massive starting principle completely unnecessary, provided you have the patience to just let it work.
And hey, this isn't just about sticking money in a savings account. It applies directly to the stock market. Since 1960, a staggering 85% of the cumulative total return of the S&P 500 literally comes from reinvested dividends and the power of compounding. Think about that. If you take your dividends in cash and spend them, you are missing out on the biggest driver of wealth in the market. You absolutely have to let your money work for you by rolling those returns right back into the machine.
And this brilliantly illustrates the ultimate philosophical divide in the markets: the investor versus the trader. The investor uses fundamental analysis, right? They're looking at economic health, financial statements, the intrinsic value of a business. They are buying a piece of a company. The trader, on the other hand, uses technical analysis to trade short-term price movements. Now, Buffett is the ultimate fundamental investor. He's focused entirely on the long-term value of the underlying business, and he completely ignores the short-term noise.
Think of these trading styles as a spectrum of, stress. Day trading is an intraday sprint focused heavily on technicals. It demands your constant, undivided attention. Swing trading gives you a little more breathing room over days or weeks. But position trading? That's Buffett's arena. You buy for the macro trends, you hold for years or even decades, and you completely free yourself from that exhausting daily grind. And there's a very real, very practical reason to avoid that intense sprint. The statistical reality is that the vast majority of short-term day traders just flat out lose money. Sure, day trading offers fast action and this sort of illusion of control, kind of like running furiously on a financial hamster wheel. But most practitioners struggle to even outpace the hidden tax of inflation, which usually hovers around a 2% target. When you factor inflation in, the short-term game becomes incredibly difficult to win. The global data completely backs this up too. A major report from the European Securities and Markets Authority uncovered a pretty brutal reality. Actively managed equity funds consistently underperform their passive counterparts net of fees over the years. When fund managers are constantly trading in and out of positions trying to beat the market, they rack up costs that severely drag down overall performance. Now, what's really interesting about this is the zero-sum nature of it all. Looking at Vanguard's data on active equity funds over a 10-year stretch, you see this massive shift into negative excess returns compared to their benchmarks. Honestly, finding a manager who can persistently beat the market after you account for ongoing costs and trading friction, it's like finding a needle in a haystack. Let's actually quantify that friction for a second. Every single time you trade, you bleed capital. It costs you an average of 42 cents in performance for every dollar spent. And the smaller the company, the worse that friction gets, ranging from 0.77% in large caps all the way to nearly 3% in small caps just to participate. The more active you are, the faster your capital evaporates. Let's move on and see how this builds when we bring in the ultimate killer of compounding: taxes. In the US, the holding period rule is arguably the most important factor in capital gains taxes. Say you acquire an asset on March 15, 2025, and sell it exactly 1 year later, on March 15, 2026, boom, you trigger short-term capital gains. But waiting just one single extra day fundamentally alters your tax burden, shifting you safely into long-term capital gains.
Here's the brutal reality of that one day. Short-term capital gains will absolutely devour your returns at ordinary income rates, going up to 37%. But if you cross that 1-year finish line, the tax code rewards your patience by dropping that rate to 15% or sometimes even 0, depending on your bracket. You're either feeding the IRS a massive slice of your pie, or you're keeping it for yourself.
So, how exactly do the ultra-wealthy protect their compounding engine? They basically use the tax code as a shield. They patiently hold assets well past that 1-year mark, they aggressively harvest losses to offset any unavoidable gains, and they use tactics like charitable donations or installment sales to spread things out. Every single move is calculated to minimize drag on the portfolio.
But, this leads to a pretty glaring question. If the math is so incredibly simple, buy good assets, keep costs low, minimize taxes, and wait, why do so few people actually pull it off? Why isn't everyone wealthy? Well, the answer lies right beneath the surface, in the deepest foundation of investing: human psychology.
Honestly, it's because our own biological wiring is our worst enemy in the market. We anchor to bad prices because of ego, we overvalue what we already own, and the second the market crashes, we stampede with the herd. Fear and greed completely hijack our logic, and that leads to the exact overtrading and premature exits that destroy exponential growth.
So the crucial point here is emotional discipline. Just look at how Buffett played the 2008 financial crisis. While the herd was completely paralyzed by fear, selling everything at the very bottom, Buffett was sitting on massive cash reserves. He used that moment of absolute maximum panic to scoop up blue-chip stocks. His emotional detachment from the chaos, combined with that unwavering discipline, let him capitalize when everyone else was capitulating. He acted on fundamentals, not fear.
Which ultimately brings us right back to you. Do you have the patience to let time do the heavy lifting for your portfolio? Because understanding Buffett's secret isn't about learning some complex algorithm. It's about mastering your own mindset. Are you going to be an emotional trader, reacting to every single headline? Or are you a disciplined investor, letting the undeniable math of compounding work its magic over decades? The choice, and the exponential growth that comes with it, is entirely up to you.